Today we're going to talk about range bars and why you should be using them, especially if you trade futures. I trade the NASDAQ, MNQ, the NASDAQ micros, and occasionally the NASDAQ big boys, and I just recently started trading the Dow too. And range bars are changing everything for me, and I want to explain why. Show you how to use it. Now I got to make my disclaimer, this is not financial advice. This is entertainment purposes only. You understand that. You trade according to your plan. If you can incorporate something you learn here, by all means do it. But this is by no means telling you this is the magic pill. There is no magic pill in trading. But I think you'll find this interesting. Now, if you don't trade futures, but you might be interested in trading futures, but you don't want to risk your money, there's a way to not do that. All you have to do is join what's called a prop firm. I happen to trade with Top Step. I'm currently in their combine. A combine is what you would qualify to trade in. And then once you qualify, you trade their money instead of your money. So it's risk-free. There is a fee. It's $50 a month for the trading combine till you pass it. This is really nominal fee. It's a whole lot cheaper than going in and trying to trade futures without getting the experience. But once you pass that combine, you start trading their money, and they start paying you 90% of it. First 10,000 is 100% yours, but after that, 90% of it's yours, 10% is theirs. If you're interested in looking into this, I got an affiliate link. I am an affiliate. There's full disclaimer. Got an affiliate link below. I'd appreciate it if you would use it. Go check them out. All right, let's get on with this about range bars. I want to talk about specifically a good way to use them. Now, there's plenty of information on range bars on the internet. I've watched several videos myself. However, I've not come across one that's talked about what I'm going to talk about in this video yet. Not that I haven't watched every one of them. I'm sure there's someone out there who has talked about this. So I know this is not unique to me. It's just something I discovered while learning and trading using range bars. Now, what is a range bar is the first question. Range bars are candlesticks, just like a candlestick. Any normal candlestick chart. You got your body, you got your wick, up and down wicks. However, the difference between a range bar and your normal candlestick chart is candlestick charts are traded on time, unless you're using a tick chart, which is traded on contracts, amount of contracts traded. A range bar is traded on price, so it is pure price action. You've heard the term, you need to learn price action to trade, along with your indicators and stuff. Well, you're getting pure price action with range bars. Whereas in a candlestick chart, let's say a 2-minute chart, you will get a new candlestick every 2 minutes, regardless of what price did. On range bars, you're setting the price that you want it to complete before it prints a new candlestick. And in this particular example, I have each one of these set to move 10 points in the NQ. Price has to move 10 points before it prints another candlestick. MNQ and NQ. I got it set for that. Now, with range bars, you have to determine the price that you want to set. So that can be a little tricky. What I suggest, and this is a suggestion only, this is how I did it. I was trading off of a 2-minute chart. So I went to a 2-minute chart and I got the ATR, the average true range. And that's what I used to set the price for my candlestick. One average true range. I think when I set these, it was 9 point something. So I just rounded it up to 10 points. So each one of these is 10 points, which is 40 ticks in the NQ and then MNQ. So 40 ticks makes 10 points. Price has to move 10 points before it prints a new bar. Now, why do I like range bars? Why do I think this would be significant in my trading? Well, let's look at something. Look at how easy it is to find structure. Here we see multiple points are tested right around here, right? See test, test, test. So we see that these are points that we need to pay attention to. This is where the action is happening. We can make something like this. And we see that stuff is happening here. Price is probably going to reverse after it consolidates at some point. So that's the first thing. We see another point here, right? Another area of consolidation. Another area of liquidity, I guess is the proper name. Now we don't see one at the bottom. However, because I use my volume profile, let me turn that on real quick. And I have two of them. Where's the other one? There it is. Second one showing the extreme. Let me get this back over onto where we're at. On expansion, no. And on expansion, no. Okay. It's kind of bright, isn't it? That's why I don't use it normally this way. But you see, I have value area extremes. It's 2 standard deviations. It's a 95 percentile. That's why I got 2 of them. Your normal one puts these 1 standard deviation. This is the value area. This area right here, point of control. Well, you notice this is the value area extreme. This is a trade I actually took today. I seen this come down to the value area extreme. I seen the rejection right here. So I jumped in on this candle right here. Now I did not ride it all the way up because I was an idiot, but I did get some of that. So let me turn this off real quick. Just had to say that. But here, back to sentence structure. Look how easy it is to find the sentence structure with these. Now, that's the first point. It's really easy to find I'm saying sentence structure. I apologize. Market structure. I don't know what I got on my mind. So let me get rid of these lines here. And I want to show you really the most important reason, I think, for using range bars. I want you to see how easy it is to find double tops and double bottoms. If you trade them, you're going to love this. And I'm shifting my trading to where that's all I'm going to be trading anymore. Look at here. Now, discount the wick. You're not looking at the wicks to figure out double tops and double bottoms here. You're just looking at the body of the candle. Okay? Double bottom. Double top. Double top. Double bottom. Double top, double top, double bottom, double bottom, double bottom. Now, if you know anything about double tops and double bottoms, it's often signals a point of reversal, right? So we see here, we come here, we see a double bottom, we see a double top, we see a double top, and we see getting in this would have chopped you up. So we could discount these. Why? Because we got a moving average here that's flat. Tells us, hey, that's not a good spot. But we see the moving average start to shift downward, and we're looking left, and we're seeing this double top, and we're seeing this double top. Both of those are good indications that at some point this market's going to roll over, and that's exactly what it did. So we're getting into trade, and we come down here, and we see a double bottom. So this might be a good point, without knowing what the future holds, to take your profit, right? But we're looking, and we're seeing another double top. We're also seeing we did not come back to our moving average, right? So we're thinking, well, next candle goes down, we'll get back in. So if you did that, you wrote it down, 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 which I did not do today, but should have. But this is higher insight right here, and I'm learning every day. You see this double bottom. What did double bottom usually signify? A rotation back up, right? Well, it didn't do it right away. If you were in this trade, though, it's a good point to take your profit off. So we're coming along, and we're seeing this area consolidation. It's not come back up here yet, so we're waiting. And then we see this, and as you saw, as I just showed you, I noticed on my volume profile, and I did take this trade, This rejection right here, the strong rejection wick. So that was a good point to get in. And then I come up and I seen this right here. This double top. This double top usually means rotate back down. So I got out. And then it consolidated, and I did not get back in. I should have, but the NQ was just so, it was devastating. It was a lot of stress to trade it today. It really was. But anyhow, had you got back in when you noticed it was up above your moving average, time to get back in, you come up here and you see what? You see a double top. You see a strong rejection wick. So you know that's a good indication this market's about to rotate back down. So if you were in this trade, it's a good spot to take your profits off, right? And we're watching this consolidating, and we're remembering double top. We see another double top. So this is telling us this thing's probably going to roll back down. We see another double top. And what did it do? Roll back down. Here's our confirmation candle. These being 10 points, had we got in right here, we would have collected 15, 16 points, right? Maybe. And we see a double bottom. So we're looking for the opportunity for the rotation. Well, we get a candle above our moving average. It's time to get back in. We're looking left. We see that double bottom telling us that was going to happen. We're coming up here. Here's a double top. It's a good spot to get out, right? And so forth and so on. And then we see a double top with strong rejection wick right there. Get back in. Because it rotated down. Again, here's another double top. Back in, rotate. Double bottom. Could have picked up a little bit there. Double top. Come down here. Again, strong rejection wick. And I don't remember what the volume profile said right here, but remember the market structure that we had. This is a point area of interest. So we know there's going to be some kind of interaction. It's either going to bounce up or bounce down off some point. Well, it bounced up here to this double top. Comes back down. So that's what I wanted to bring out about these range bar charts. And if you don't know how to set up a range bar chart, let me show you real quick. This is ThinkorSwim. Click on here. You go to time axis. Now you're going to see yours probably set up like this. Time. This is standard default charts, time-based charts. So you're going to come down here. You're going to select range. You're going to select the amount of days you want to look back. I do 5 days. And then you're going to figure out the amount of ticks. Remember, ticks are not points. 1 point in price movement for the NQ is 4 ticks. So I wanted 10 points of price movement. That's 40 ticks. You set that right there. This doesn't matter if it's checked or unchecked. Doesn't matter. But here it does matter. You have wrinkle bars and you have range bars. Set it to range bars. Wrinkle bars, I looked into those. You're missing a lot of information you need to trade, especially if you're day trading. You're not going to get this wick information from wrinkle bars. I advise not using those, but that's completely up to you, your decision. But for this video, range bars, right? So we're setting it to range. Days to look back, amount of ticks, figure out how many ticks is in a point. This is on the micros. And then you click apply, okay, and then you got it. You got range bars. And that's how you do it. So if this video helped you, found something good about it, how about smashing that like button for me? Leave a comment. Let me know what you think about this. Let me know if you've had any experience about it. I'd like to hear what you guys got to say. And you have a good day.